Yes, my name is Ray. I work at Fastmarkets Agri-Centers, covering mainly the cash, soft oil and oilseed prices around the globe. So I will take you for a whistle-stop tour around the world, basically go a bit back of how we ended up in this environment of high prices and how we hopefully should go back to a more normal situation going forward. So key takeaways, I'd like to do key takeaways rather than content. So if I'm aware that I'm the fourth person to speak today, it's quite late. Many people want to either go for their dinner or for their lunch. So if you don't want to listen to anything I have to say, that the key takeaways are Black Sea sun oil prices hit a record high, but there's a large crop expected in the Black Sea. Palm oil production will rebound as well, but gains will be limited. And finally, Argentine soy oil supplies were hit by strikes in 2020. But that will be recovering this year as well, hopefully. So that is the key takeaways, and I will touch on those three continuous points throughout the session. So what I have here is the Black Sea, basically sunseeds crop globally. I have the biggest producers on the top side there. So it's the European Union, Argentina, Ukraine, and Russia. Ukraine and Russia is by far the biggest ones. And they produce the bulk of the seeds and also the bulk of the sunflower oil being shipped globally. So we had a severe supply shock last year, whereby the biggest producers and all of the countries in the Black Sea, so that's again Russia, Turkey, and Ukraine, but also smaller nations like Romania, etc., were all hit by a drought late in the summer here. So that basically wiped out 5.5 million tons of sunseed production globally, which is equivalent to 12%. That's what I've shown on the lower chart on the bottom left. So it's basically the biggest supply crunch we've had probably in a few decades, probably the biggest on record. I didn't go back more than 2 decades, but it is quite a severe shock. And that basically caused a massive scramble for both Black Sea sun seeds as well as sun oil globally. So the 5.5 million tons of sun seeds wiped off the supply chain basically meant 2 million tons of sun oil not being exported, but just there was the lack of sun oil. Then whilst we talk about supply, we also need to talk about demand. If we talk about sun oil, we need to talk about India. India is by far the biggest edible oil importer globally. It is their third biggest import ticket after crude oil and gold. So it is quite a big deal in India. They import around about 15 to 60 million tons of oils in general, half of that being palm, with the other half filled up by sun oil and soy oil, and both of them compete between the two. Now I've put up, this is the monthly import as in stacked areas. So on the top you see well, basically the last couple of months, which I've put in, and you see a big crunch in March and April 2020. Obviously, that's the start of COVID, and then a resurgence in that. But the interesting bit is what I've shown there, and this is the nugget of this slide, is that I've put in the import share by oil at the bottom left. And as you can see, that crunch resulted in a fall in the share that palm oil has in India, while actually sun oil and soy oil were by far more stable. And that is effectively because palm oil is mainly used in what they call in India the HoReCa sector, or hotels, restaurants, and cafes, bars, pubs, things like that, while sun oil and soy oil is more demanded by households that have, and they like to spend more on that. It's a prime real estate to have a nice vegetable oil on your shelf in India, and they do pay an extra penny for decent, nice Ukrainian sun oil, which has this premium flavor to it. So that is why it is fairly inelastic demand. Now, inelasticity obviously breaks at some point. So that comes to sun oil and soy oil. So here are the prices I've charted of sun oil in the dark blue, followed by the green one is Argentina. So these are FOB prices, so they're not landed in India. Obviously, you need to add some freight rates to that, but it just gives you an idea of the share, of the price of each of those soft oils, as well as the spread between the two. The bars at the bottom are the spread. So the spread effectively went from the usual range of $50 to $100 to $500, and that's basically where it broke. You see sun oil reached a record high of $1,700 a ton. It's more than double what the price was at a similar time last year. And effectively, because of that, it outpriced itself. And now it's doing this weird little thing where it doesn't really know where to price itself, because on the one hand, India stopped buying big amounts because it's now buying more soy oil from Argentina, which is why prices there went up. But while no one is buying it, at the same time, there isn't any left. So it's kind of like, what's the price? Because no one's buying it and no one's selling it. So it's a very opaque market at the moment, old crop prices. And it has outpriced itself. So it's been quite an exciting year for sure. So obviously, with prices for food going out of control, governments like to step in and show them they're in control. So I've just highlighted here a few bits that were done in the sunseed, sun oil, vegetable oil space of the last 12 months. So obviously, with the supply crunch last September, it caused a massive surge in exports of both seeds and oil, because everyone was scrambling, aiming to get their export in as quickly, or their imports in as quickly as possible before supply dried up. So that caused a surge in sunseed exports from Russia, mainly to Europe. European Union is a net importer of both sun oil and sun seeds, just because there's plenty of people living there and not enough farmers growing it themselves. So Russia said, well, enough's enough. They slapped a duty on the exports of 30% at the start of this year. That effectively dried up all the supply to the European Union. And that meant that crush of sun seeds there stopped or fell to a trickle. And that capacity then moved to rapeseed, as well as soybeans that went straight ahead. So Russia is moving that 30% further up from 50, because why not? When you're in Rome, go ahead. So they've moved it up to 50%. And with the Russian government, you never know when they will move it back. So for now, it is 50% for the time being. They also intervened with domestic prices of sun oil. Again, Russians like to have a bottle of sun oil on their shelves at a decent price. So Putin, liking to keep his people happy, he brokered a deal between domestic crushers and retailers to effectively fix the price between whatever the crushers sell to the retailers and effectively what the retailers sell to the Russian societies. That is fixed by rubles per liter. I think it was 100 rubles per liter. And that was fixed. It was then continued, and that will now continue until September. So that meant, obviously, that many of the crushers in Russia were running in the red, because they were buying quite expensive seeds and selling the oil at sub-market prices, which never really works well economically. So then they were issued subsidies to keep them sweet for the time being. So Russia will introduce from next marketing year, so September onwards, they will slap on an export duty on sun oil, keep the sunseed export duty probably in place, and introduce one on sun oil, which they call a plunger. Is that the word? Probably not, but it's basically 70% on the difference between a reference price. In this case, they will use the Reuters price, published price, and a fixed price of £1,000 a ton. So remember, at the moment, Ukrainian sun oil, which is closely related to Russian sun oil, is at $1,500 a ton. But obviously last year we were at probably $800 a ton, just to give you an idea of how that would potentially work. Ukraine tried to do, being inspired by Russia, tried to do the similar things, trying to intervene with retail prices, etc., etc. It seemed there that the industry had a stronger grip on the free market, at least, and that didn't pan out. But effectively, in the end, they did agree on an export quota of 5.38 million tons. Normally, in a normal or like good record year or good crop years, Ukraine would export something like 6 million tons of sun oil. But even now, even with that quota in place, they will probably not even hit that quota. They will probably only export 5.2, 5.3-ish. So it is a measure, but it doesn't really mean anything effectively. Turkey, just across the Black Sea, they are both short sun seeds and sun oil, so they switch importing between the two, and they have reduced import duties on sun seeds. And they've also asked TMO, which is their grain importer. So normally they just buy wheat and corn, they don't really know too much about edible oils, but they've asked them anyway to import it. Why? Because they are not, they do not need to pay import tax because they're state-owned, and everyone else has to. So they thought about alleviating the market that way. So that was a little interesting quirk of what happened this marketing year. India, notorious for changing its import duties all the time, moved palm oil duty, talking about palm oil here now, but palm oil down in November, moved it back up in February. It is stuck between trying to reduce the cost of importing and keeping food prices stable, while at the same time protecting its farmers and the prices domestically. And Modi obviously has a lot of farmers voting for him, so he doesn't like to annoy them too much. So this is why there's this pull and tear between higher and lower import duties in India. So obviously, as the old saying goes, high prices cure high prices, low prices cure low prices. Basically taking the chart or the charts from the first slide I had and added 2021-22 here. Looks like I mistyped that y-axis there, but it should be 2021-22. So this is the estimate. This is what they are currently sowing in the Black Sea. They're probably now 80% complete, both in Russia and Ukraine, so close to the finish line, despite an earlier setback of some cold weather. And as you can see, this is the USDA estimate, which is likely to reach whatever we had in 2019-20, but probably go beyond that. And Ukraine is set to now sow again 7 million hectares of sun seeds, but that will probably be beaten as well. Russia will be at 9 million hectares, but that will probably be higher as well. So all the farmers are trying to plant as much as possible. Why? Because the sun seeds have just gone twice in price. So what was already a cash crop in both countries is now becoming an even more lucrative crop. So the farmers are trying to stuff the soils full with sun seeds as much as they can. So that then at the lower chart, you see that while we lost 5.5 million tons of sun seed last year, we should get back 5.7, and that should result in a bit lower sun oil export increase of 1.5 million tons. So it should improve, but it won't alleviate all the worries we have at the moment. So we should see lower prices. And that's what we are currently seeing already. So if you look at the FOB Ukraine sunflower oil market, at the moment we are around $1,500. There's a steep inverse to new crop of 300. Normally that inverse is only 20 to 50. So at one point, old crop and new crop prices, when we move from old crop to new crop, these prices will have to meet some way or another. And this steep inverse will have to pan out. So is it old crop prices falling to meet new crop, or new crop rising to meet old crop? Reality will probably somewhere be in the middle. But you can see both buyers and sellers are hesitating, because while 1,200 for new crop looks to be a bargain in the current market, 1,200 is still nearly 50% higher than what it was the year before in a similar market situation. So it is a bit like, are you willing to take the risk, or do you just hedge and just forget about it and sleep well, maybe at a high price? So that's basically the roundup of sunflower oil. Moving on to Argentina. Tori already spoke a lot about this. So basically a bit more detail on what I have here of Argentine crushing. So 2020 the soybean crush was the lowest in 7 years, just because of multiple setbacks. It was just under 36 million tons of beans that went through the grind in Argentina, which, by the way, is the biggest exporter of soy oil and soy meal. So that's why we are looking at Argentina quite a lot. The biggest setbacks, as Tori already mentioned, is the low farmer selling, inflationary measures, stress about COVID, obviously not the best economic circumstances going on in Argentina at the moment. So farmers are trying to hedge using their beans, so they're not trying to sell it. And strikes have been paramount. At the moment, we got a new strike in Argentina. They strike more than the French, interestingly, but They are striking again because they want COVID vaccine. So that means that the crushers are probably going to crush less in the next couple of days. But last year they were crushing for higher wages, higher bonus pays, etc. And that basically, you see the green bars for 2020 in the top chart. The December one was a record low for December. So normally they would be crushing somewhere between 2 million and 2.5 million just for that month, which is always a bit of a lower month regardless. But it was basically the worst result ever. And that was because they were striking for 3 or 4 weeks straight, which is obviously nice to strike over Christmas and New Year's period, but it doesn't really help the supply book. So that supported prices there. Now, going into 2021, the crushers have been trying to catch up quite steeply. And with the 4 months of data that's out now up until April, it's the fastest pace since 2016 so far of crushing and the second fastest on record. Largely because bean crop is better. They've harvested 52 million now. So that's up from the 47 million they've harvested last year. So there's a bit more supply. The drought concerns were there, but weren't really that bad after all, despite some initial worries. And yeah, it looks a bit better. So farmers have been selling. Obviously, if more troubles are on the way, if there's more issues economically in Argentina, they will slow down the crushing, and that can put the brakes on the crush. We have also an election later this year in Argentina in October. So it depends to see what the government does before and does after that instance. But the farmers will keep a close eye on that and will change their selling behavior depending on what will come out of that. And then to go back on biodiesel there, yes, biodiesel has been, biodiesel blending could be lowered, as Tori already mentioned. The law is up for renewal, or needs to be discussed, or is currently being discussed within the Argentinian government. And there's a lot of talk to lower it to as low as 3 to 5%, or even below that. The biodiesel lobby told us in Argentina that could free up about 500,000 tons of soybean oil additional to the export market. Now, if that oil will obviously hit export market and will be exported, we don't know. It depends to be seen. Someone will need to buy that, and it will definitely put pressure on soy oil prices from Argentina, and therefore probably drag sun oil prices down with it. But as with anything in Argentina, you never really know. So we'll have to keep a close eye on this. But yeah, they'd like to lower blend rates in Argentina just because edible oils are so expensive. And this is what's happening in neighboring Brazil as well. They've lowered the blend rate from B12 to B10 temporarily, and then extended it for another 2 months. Which is why they're looking to lower it. So this is a bit of a roundup of Argentina. As we talk about edible oils, we can't really ignore palm oil. So palm oil had some severe setbacks in 2020. There was a general tendency of lower fertilizer application at the end of 2019, which caused yields already to drop going into 2020. Then throw in COVID, that basically caused for a lot of problems in Malaysia, second biggest exporter and producer after Indonesia, just because a lot of the labor force that works on these palm oil plantations is foreign. I think over half is actually foreign, coming from all sorts of places in Southeast Asia. Now, if you put COVID restrictions there and travel restrictions there, you can't really rely on those people to come back. Some of the people went back home to their home countries and never came back because they couldn't and they didn't want to risk it. So they had a severe problem now. And now with the second wave happening in Malaysia, similar to India's second wave, today the Malaysian government announced that the workforce in palm oil plantations will be lowered to only 60% of its total capacity to curb the spread of COVID-19. So that means you have fewer people walking around the plantations collecting those palm fruits, and therefore we should expect output to at least take a hit in the short to medium term until that regulation is lifted, and God knows when that is. But nevertheless, the outlook does remain positive. It will recover both in Indonesia and in Malaysia. I think Indonesia is looking now, well, it lost 500,000 tons of palm oil production and fell to 19 million tons output in 2020. It's now looking at 19.7. Hold on. Here we go. It's now looking at 19.7%. Indonesia will also move back higher to 44.5 million metric tons production. So Indonesia is a bit more growth. The problem with palm oil, and this will be the problem going forward, is that it's always been this booming edible oil, keeping everything cheap because the palm oil output was just so extensive. And that's just because the expansion in area they had and the loss of the rainforest with it. Now that is coming to an end, not per se because of the clampdown and all of it, but just because there's limitations on it now. And that's why the growth in palm oil production will slow down. Therefore, the growth in global demand will have to shift to other oils, and palm oil will have less of a share. And then the last bit is, even with the production rebound to come in, Malaysian palm oils will take a while to come back above 2 million tons, which is this magical number that people look at. Currently, we are at 1.6 million tons. So on the bottom right chart, I have the purple line is the current latest stocks, and then the dotted purple line is the forecast by the Jacobsen, which Tori was so kind enough to provide me. Just for reference, the red line is the 5-year average. So it just shows how tight we've been. I think global palm oil stocks are only at 20% of usage. So it is quite tight, and that's keeping palm oil prices high. Then we need to quickly talk about rapeseed. We've talked a lot about rapeseed already. I think my points on rapeseed are the expansion in rapeseed over the last 20 years in both area and production, which you can see on the top right side, has slowed. That in part is because China is producing less, but also the EU. The EU is mainly because the European Commission, that likes to make everything more overly complicated, barred the usage of neonicotinoids on the crop, which is a pesticide, which is bad for insects and bee population, etc. So the European Union banned that, making rapeseed, turning it from a cash crop for European farmers to a risk crop, or maybe not as profitable as it used to be. So many farmers have moved to other stuff or have planted less of it. At the same time, the European Union is importing record amounts from countries that do allow these neonicotinoids, such as Ukraine, maybe not this season as much, but other countries at least. So yeah, we've seen European rapeseed oil futures hit a record high, also in sync with canola futures in Canada. And that we've also seen that rapeseed oil prices, which is the cash prices in Rotterdam, that hit a record high as well of 1,300 euros earlier this year. Tim earlier brought up the EU biodiesel legislation. So they want to bar palm oil methyl ester because of the deforestation concerns. And that will also potentially be extended to soybean oil methyl ester just because of the concerns about the Amazon, etc. So that will basically leave used cooking oil and RME or rapeseed oil methyl ester to go into Europe's biofuel mix. But obviously, refer back to Tim's presentation on that because he's a specialist. Quick bit on US, because we can't talk about the world if you don't talk about the US. Here, my points on the US is that while the US had a very decent soybean crop last September, we turned from a surplus to tightness in just a matter of months because a record amount was exported to China, as we all know. It was a record of 23.1 million just in Q4 alone, which is the main exporting window for the US. So beans being exported to China. Normally I think it exports between 10 and 50 million tons of beans to China in that window of 3 months. Bean crushing has also been going ahead quite well. So I've put here the brown bars at the bottom are 2020, 21. I've also added the latest in yellow, which is the NOPA estimate, which is a bit lower than expected. And then the 5-year average. So bean crushing has been going ahead, export been going ahead. So bean stocks or bean ending stocks for the US are at a 7-year low, or at least near a 7-year low. And I think April soy oil stocks, which was NOPO quoted, are the lowest since 2015 for the month of April. So everything's quite tight in the US, and that comes to pull it all together. I've looked here at CBOT versus the Bursa Malaysia. So we're looking at soybean oil versus palm oil in dollars per metric ton. So I've taken the ringgits out and the cents per pound and converted into normal money, and then looked at the spread. So you can see soy oil obviously surging to a 13-year high. It briefly touched 70 cents per pound earlier this month, I believe. We're a bit lower now because of a bigger correction on CBOT. But that has pulled up palm oil. That reached a record high earlier this month, palm oil. And the spread has widened between the two contracts to over $400. It depends, of course, which one you compare. I'm comparing the benchmark contracts or most liquid positions on either contracts or either futures contract. So yeah, that would favor palm oil over soy oil. And that's kind of what we're seeing with India, even though they're struggling with their own COVID wave. But also what we've been seeing at China is that they're washing out soy oil cargoes in favor of palm oil. So a bit of a mixed bag. Obviously, we always have unknowns. Weather, we had already a cold snap in the Black Sea, and that delayed plantings by 2 to 3 weeks there. So while it's not really a big issue for yield, because most of the yield of some seeds is established between July and August, it's just something that, while it looks all better than last year, we're not out of the woods yet. Then a big question mark, will the US deliver on the bean crop? That's yet to be seen as well. The issues on Argentina that we already mentioned, inflation, economic worries, farm selling, whether crush will keep going ahead at its normal pace or its current pace, etc. And then finally, the big elephant in the room that we haven't really talked about yet is China. Well, they say they will crush a record bean crush of 100 million tons in 2021-22. Their veg oil imports will also hit a record. So there's just a lot of demand coming from China and will continue to come from China. So that will keep both beans and oil supported as they continue to buy up commodities around the globe. And then finally, I have here the forecast by the Jacobsen. So thanks again to Thore for providing me this. Whilst we are now at, in the range of 65, 70 cents a pound, the current forecast by the Jacobsen shows that that trend probably will stay in place until May 2022 at least. That's the two things I need to note here from Thore was that there's a seasonal tendency for the contract to decline once bean plantings have been going ahead and have been completed and we're in good state. So that should always put a bit of pressure down. So if that does happen this time, which is yet to be seen given the tight supply on soybean oil in the US, if it's this time, then the forecast will be revised. However, on the flip side of that is more biodiesel capacity is coming online in the fourth quarter of this year. So that will put more pressure on as well. So basically, prices will remain supported for a while to come. And then this slide was provided by me as well by Thore. So these are cash prices within the US. This is price assessments done by the Jacobsen, as we don't really have too many price assessments ourselves as AgriSenses within the US. So here the spread between RBD and crude hit a record. The RBD is a refined oil. So that is basically because refiners have been struggling to source, or new refiners have been struggling to source soybean oil or crude soybean oil to refine into RBD. And there's also been capacity constraints to actually refine enough. So that has caused the spread between RBD and crude to spike. There is expansion on the way in refinery, but that will only come online, or will not come online before the end of 2022. So that's not the best outlook on the supply side. And then one note as well is that surprisingly, the refiners with capacity, they did not stand for delivery from the CME soybean oil contract, which is interesting. We don't really know why, but that might change during the rest of 2021.